All right, so in today's video, we're going to take a look at finding cheap stocks to do the wheel strategy. So if you're kind of new to option trading and you want to do the wheel strategy, but you want to do it cautiously, let's say the first couple of months, doing it on cheap stocks is actually not a bad idea because it won't burn you as badly if you get hurt. So it's kind of like, hey, test the waters, right? You don't need to trade the big stocks right away. You could trade some of the smaller ones. So that's where I think doing some of the cheap stocks at the beginning, and then later you could put in more like your $100,000 or $5 million, or some of the guys I work with, they're in the $50 million or $100 million range. So anyways, depending on how you go in and look at your evolution of trading, will depend on if you want to trade cheap stocks. Other cases, you might say, well, I just don't have a lot of money. Anyway, as we look into this, it's kind of a common question that happens. What stocks between 5 and 15 are you doing for weekly or 2 weekly for the wheel strategy, and why? So I'll show you some insight here on kind of how you could set up the scan, and then you could find your own. I don't think it matters as much as far as like stock specific, hey, this one or this one or this one. It's more about finding things that you're willing to stick with for usually 3 or 6 months or longer. Because the wheel strategy, the way it evolves and works is if you do it for 3 or 6 months, that's where the probabilities start becoming a little more in your favor. So if we look at certain stocks and we go to the scan criteria here, I'm just going to go put in, we're going to scan in the weeklies. So this will be kind of here, and we'll go to the weeklies. So make sure we're scanning in the weeklies, stocks that trade weekly options. And then the last price will be between $5 and $15. Now, right here, we've got 87 matches that trade weeklies. The reason I don't want to do things that don't trade weeklies is because it limits my flexibility. So then I'll hit scan. I'll make sure I have 1,000 results. And there's my 89 candidates. Now, next thing I'm going to do is I'm going to sort by volume. And the biggest volume here is the SQQQ. So you can see it's $8.24. Now, you do want to be careful in these cases is when you do find these things, because it's cheaper. It's basically the Ultra Pro Short QQQs. You may not always want to do these things, but what you're really looking for is kind of the option spreads of how they're moving, acting, behaving, and in addition, the price behind it. So if I do the SQQQ, it's an $8.24 vehicle right now. And then the next one I would sell would be, let's say I'm doing the wheel strategy, $8.50, but I'm only collecting about 15 cents, 16 cents of premium. So about 15, 16 bucks. And if I go to the 9, only about $7 worth. So it's a little bit more difficult, right? What happens is the difficulty level occurs because you're not really getting a lot of premium or bang for your buck. Whereas if you do like just the QQQ on its own, obviously that's a $482 vehicle at this point. And then if I go to about a 15-day time frame, well, already you're in the $300 range for that premium. So you get to make a lot more in those cases. But if we're trying to trade cheaper stocks, here's some that, you know, you could look at. We've got TSLL. This is the Tesla Bull 2 times ETF. Again, it's pretty liquid. It's pretty active, but again, it's a cheaper stock, ETF really. And just looked at this one earlier today. And here, when we go in and look at this, we still have kind of a wide bid-ask spread. So be careful when you're doing these things. And also the implied volatility here is a little high. So you do want to be careful. And because of that, you'll have a wider bid-ask spread. So I was chatting with somebody about this today on one of the coaching things, one-on-one sessions I was doing. And, you know, they were looking into this one. And, you know, we were just talking about the bid-ask spread here where, you know, between 31 and 35 cents, it's still a fairly wide bid-ask spread for a $7.91 stock or ETF. Whereas if you go to SPY, for a $400, $500 vehicle here, you're getting like a 2 cent wide bid-ask spread. So it just goes to show you. So even though this one is kind of like Tesla, it's very active and it's got like this own ETF thing going, it's actually still fairly wide bid-ask spread for what it is. So this is one of the things you're kind of watching. Whereas like something like a Ford, I'd be more into, because when you look at a Ford, it's an $11 vehicle. Now the premium stinks and you might have to go in, go like a month out to get any form of premium. But what happens is the volatility is a little more calm. Then you've got the bid-ask spread. It's a 1 penny wide here. It trade weeklies, so it looks pretty good from that perspective. So as you start going down the list, you'll probably realize the ones that I would probably pick versus the ones I would not pick. So American Airlines, I'd probably pick American Airlines. It's a little more stable. Whereas this IREN, which I pulled up earlier just to check, the implied volatility here is, I think, 118, 119. So I would not pick that one. And if we look at this here, there's the implied volatility. You can see it's about 110. And then if you look at the bid-ask spread, also about 10 cents wide. Now, in some cases, you might like these from a stock perspective because the stock did explode. It went well. It moved well. And, you could get some movements. Otherwise, it's moving sideways and then it explodes and it does well. But I'm just saying, be a little bit more careful when you're doing like the wheel strategy on some of these things that are a little bit hyperactive. It can be a little more problematic. So that's why I'd stick to a little bit more stability, so things that you probably know, things you are aware of, maybe a JetBlue, maybe even here, like, I don't know if I do Under Armour. So some of these cheaper stocks are a little bit tricky simply because of, the volatility effect or problem, or you're not going to get a lot of option option premium. So here's Lyft. If we take a look at Lyft and we go in LYFT, it's under 15 bucks, and you got a 64 volatility, and then you've got a couple of strikes that you have some form of premium you could sell. You'll just be a little bit tighter. And then if you compare AAL here, also similar, you got maybe like one or two strikes above it because it's 11.24 right now. JetBlue I haven't looked at in a while. Let me see this one. So it's about a $6 stock, 570. So making about 15 bucks. So it's possible, but just understand you'll have to be closer and tighter to at the money or something to that effect. So anyway, that's kind of the way I would approach it. When you're looking and scanning for these things, make sure they trade weeklies. If they don't trade weeklies, you could get stuck into those positions. But for example, stuff like CGC, like there's a Canopy Growth, CGC, $7 for the stock, but the volatility is crazy. I would probably avoid these for a $5 wide, 5 cent bid ask spread with. For these types of stocks, it's just not in the wheelhouse. Like there's not a lot of trend. There's volumes all over the place. The stability's not there. So I would be a little more careful with things of that nature. Let's go to ALT here. Here's another one. ALT, also more higher implied volatility. Now you've got a 10 cent wide bid-ask spread or 5 cents here and there. You could try to split it and it's fine. You've got a few option premiums here and there as far as the strikes go. But again, the stock's kind of trending lower in general. So remember, a covered call wheel strategy, usually you're making money as that stock is heading higher or to the upside. Otherwise, you might have to sell extras or beyond the normal level. And in those cases, it may be, not as favorable. So anyways, be mindful, be careful in those cases when you're doing stuff like this. With cheaper stocks, they have a higher volatility. They bounce around. It's kind of like similar to penny stocks. So you definitely want to pay a little more attention, maybe trade in smaller sizes. But if you're starting to learn, hey, it's not a bad spot to learn. Then later you could put more money in. But if you don't have more money, unfortunately, that's where you'll have to stick to for a while until that account builds up and grows, and then you can move on to other areas. But you do have to kind of, in fact, when you're dealing with cheaper stocks like this and higher implied volatility, in fact, you have to be, a better trader to actually be profitable. Unfortunately, when you have less money or capital, if that's where you're at, and the reason you're trading smaller stocks is you in fact have to be a better trader than when you have more money, because having more money or more cushion allows you to have errors where you can actually make that back quicker or faster, and it cushions you a little bit. So be mindful. Now, if you're starting this as from a learning perspective to doing the wheel strategy on cheaper stocks, just to make sure you don't get burned, that's fine. That's a different perspective. But over time, you'll find that it actually is a little bit easier to trade stocks that have a little bit more strikes, more liquidity, tighter bid-ask spreads, and it's actually a little bit easier in some degrees. So anyways, I hope that helps, gives you a little insight. Truly appreciate it. And I will see you next time. Take care. Bye-bye.